In this week's update, US indices marching on despite the uncertainty. Just irrational animal spirits, or is the outlook that good? And such a smorgasbord of new, different opportunities. My name is Garry Davis. I'm an authorised representative of Primary Securities, and the information presented here is general information only. Right, let's look at US earnings because it's been a big week and a little bit, and so far so good. The results have been very good. The beat rates have been right up there with the typically highest level that you see. So things at this point in time are looking very good for the US market. And at the end of the day, it's always about earnings. That is the long-term driver of stock prices. It's earnings. In the short term, over periods of months, the price can do something different from the direction of the earnings because of perceptions about valuation, because of sentiment, because of all sorts of reasons. But at the end of the day, that's what drives the prices. And just in the last week, there was about an 80% beat rate on earnings, which is really, really good. But it's the week coming will really tell the tale. I'll come back to that. Now, Trump has probably unleashed some animal spirits that can be self-fulfilling. You know, you think about when you get everybody embracing that the future can be better, then how are corporates going to respond to that? Are they going to tend to hire more? Are they going to tend to invest more? Are they going to do it with more confidence? Maybe try new things. And when they do, and some of those work, and the business is better for it, then it becomes an upward spiral. So hope and expectations, do not undersell the importance of hope and expectations. Now, if you hate Trump in really absolute terms, that's fine, but you've got to separate that from the potential impact that he has on investing just because of this unleashing of animal spirits. Justified or not, it is what it is. And that is one of the most exciting things about the next few years, just how far can that self-propelling cycle to the upside in terms of companies investing and building their earnings and driving stock prices. Now, there are some risks, of course, one of which is that there's going to be very strident opposition. There are multiple Republican-dominated states. They are resisting. They will resist with absolutely everything that they've got. So much for democracy. The vote was democratic. It was clear. And yet some states are saying, well, we actually don't respect democracy because we don't like the policies. Well, I'm not sure that's how democracies work. But anyway, we'll see how that one works out. Irrespective, I think the earnings per share growth will prevail. And I'll show you a couple of charts in just a minute that illustrate what happened last week. But now it's really important also to follow the money, not just invest on hope and expectation. You've also got to follow the money. And just a couple of examples of things that happened last week. Meta has announced that they're investing $65 billion in huge data centers to achieve their AI ambitions. And that reportedly the size of the data centers we're talking about could fill up a fair bit of the footprint of Manhattan. That's how big they are. So when you start to think about whether AI is going to lead to these amazing growth in companies, you've got to embrace the fact that we're probably in a new paradigm now where the dimension of the investment is almost beyond our comprehension. I think you've got to at least be open to that possibility. And when you get that sort of committed investment from the likes of Meta and Google and Microsoft, etc., then, who knows where this goes? It's very, very difficult to envisage where the limits might be, but I think the growth rate is going to be very, very substantial. And then also through the week, there was the announcement or discussion, whatever you want to call it, about the Stargate AI project, which is reportedly a $500 billion commitment between private and government to build AI infrastructure. America is not going to be found wanting. They're not going to allow their leadership to be taken away in AI because it's ultimately about things like national security. So, there is just staggering sums of money that are lined up. So, I kind of smile when I read articles that say that, the levels of investment that the Googles and the Amazons and the Metas have been undertaking is not sustainable. It may not be sustainable using the paradigm that applied in the last 5-10 years, but it may be very sustainable using a different paradigm where enthusiasm and hope for a much better corporate future is prevailing. And then, of course, when you've got that level of investment, you don't have to play that via the major obvious players. All of the related beneficiaries, companies that might only be $1 billion in market cap or $10 billion in market cap, there is going to be just hundreds and hundreds of beneficiaries of all of this money that's going into expansion, because rapid expansion of anything creates other unintended problems, which then have to be solved. And so companies will line up to solve those problems. And just one example, for instance, is this incredible growth in data centers to deal with the computing requirements of AI is cooling. You've got to get the electricity in there, and then you got to take away the heat. And that's just one example where companies that have got solutions to this heating problem are going to make a lot of money. So I'd encourage investors to think about all the related beneficiaries. You don't have to all jump into a trade, which is probably already fairly crowded. Now, the biggest risk to all this, there are multiple ones. It's just the sheer uncertainty of Trump that creates those uncertainties. But for me, the biggest one is the trade shocks. We don't know to what degree all his bluster about 60% tariffs on China or 25% tariffs on Canada and Mexico. We don't know to what degree that he really intends that, because that's just his negotiating style. He's also been noted as taking a much softer view on China as well, reportedly saying something along the lines of it, I don't really want to do this. So we've just got this massive big uncertainty. But the one thing that we do have is that we've got this unleashing of these animal spirits. And I'll come back to that, because that's, I think, the whole point of how we should look at investing in 2025. So let's just have a quick look at some examples of what happened last week in terms of earnings. So this is following the money. This is not speculation. This is not the market massively increasing the valuation multiples because of speculation. This is Netflix. They gapped up from around about $860 to almost $1,000 on record earnings, and also net subscriber growth to about 19 million during that quarter. So that price has jumped for real, tangible reasons. This is not speculation. This is not the market getting ahead of itself. Let's look at Twilio, sharply improving outlook. And, look what the share price did. It went up 20% on Friday night. This is Interactive Brokers, so in the financial sector. So obviously, the first two are in technology, Interactive Brokers in the financial sector. Big beats on top and bottom lines. Look what the share price did. Charles Schwab also beat consensus, wasn't left behind. Very significant increase. Let's go into the grassroots industrial. It doesn't get much more grassroots than 3M company. And yet their results were good enough to really rocket the share price up into a breakout. And back in the technology area, this is Seagate Technology. They also beat consensus, and the price moved up by about 25%, and on good volumes as well. So there's no question that what's happened in America in the last week or last couple of weeks is being driven by earnings. It's not being driven by speculation. This is not just, oh, Trump won the election, he's probably going to be good for business, so we'll really pump stocks up. This is much, much more tangible than that, and that's probably the main message I want to get across in this video. Now, of course, as always, the point I make is that those significant investment gains are available if you're organised and you're disciplined. If you're not, then it's so easy to lose money in the stock market. So please remember that. Organisation and discipline and clarity are the absolute keys here. American stocks, the S&P rose 1.75% for the week. The Nasdaq slightly less, still pretty solid. IWM, the Russell 2000, so the breadth was good. The Russell went up by a similar amount. But it's next week that will really tell the tale, because 5 of the 7 Magnificent 7 stocks are reporting. So that will be a really important week for earnings. As far as the week just gone, XLK was the best. Now, the US dollar had shot up almost to 110, but it pulled right back and basically has retested the breakout that it made a couple of weeks ago back at 107.5. The 10-year yield was steady, so that was good. 10-year yield didn't start to work its way up again, and the VIX was a little bit lower at 14.8. Let's go and look at some US charts. And we'll start with the NASDAQ weekly chart. We're still in strong uptrend. We had a pullback that started at the end of 2021. That pullback in the NASDAQ, which really involved all those Mag 7 stocks, had just got ahead of themselves during that post-COVID period. And so there was a rethink. There was a retracement. And that occurred throughout 2022, or virtually the entire calendar year. And then once that excess was wrung out of the market, then the NASDAQ stocks and technology stocks have taken off again. And the index has run from around 12,000 to 22,000. So it's almost a doubling since the bottom of 2022. So a couple of years. And there are absolutely no signs that this is running out of puff. It's just continuing to take 3 steps forward, 1 step back, 3 steps forward, 1 step back. If we look at the S&P, this is a weekly chart. You can see we're basically at all-time highs on the S&P, closed above 6,100 points. That's looking very strong. IWM needs to do a little bit of work to break out into new territory, but it's not that far away. Semiconductors, always important, are consolidating. And it's incredibly encouraging that the NASDAQ has been able to trend like that while semiconductors have been going sideways. So that, they've been going sideways since the middle of last year. So that means that many other technology stocks are doing the hard yards for the NASDAQ to have continued to rise. That's a very good thing for the market, that it's not just reliant on one robust but narrow sector of the market. Now, if we look at the relative comparison from the start of the Fed rate cut, so we did this last week, but we'll look at the same time frame, and there's really been no change in the order. So the pecking order is exactly the same. And you can see that virtually every sector went up last week. So that's the main message from last week. In Australia, over the last week, finance and IT remain very strong, and small caps as well remain in pretty robust condition. Let's just pan back a bit in the last month. Okay, so we're just starting to see energy, which had really picked up over the last month. But energy really backed off last week, which is what you'd expect given that the oil price came down a little bit. Finance is still going well, but as I'll get to in just a minute, it's unfathomable what is happening in the major banking sector. But not much else to determine there from the Australian market. The Aussie dollar was marginally higher, got down to 61 a week or so ago, but we've jumped up about 1.5 cents as the US dollar came off. Our index was 1.2% for the week. Banks are at historically extreme valuations. CBA, ditto, plus. It's just quite incredible what is driving that price. And then we've got the issue of tariffs, what happens with tariffs, because they will impact China and it will impact our materials sector. So when you've got the two main contributors to our index being the banks and materials sector, one at extreme, seemingly unsustainable levels, and the other one facing uncertain headwinds, it's really hard to be bullish about the ASX 200, that's for sure. Let's just take a quick look at the currencies. So the US, first of all, so you can see this is a weekly chart. So we had a multi-week breakout, 4 weeks of breakout, and then a very abrupt retest of that breakout. Hard to know what's going to happen here with the US dollar because there is certainly some funds outflow from the American financial system. So whether that translates to the fact that the US dollar has peaked, I really don't have an opinion, don't want to have an opinion at this point in time. The Australian dollar managed to jump a little bit as a consequence. All right, precious metals now. Oh, just the final point on Australia. A concern, but I'm a little wary that given what I've set up here, that we could get a sudden sentiment downdraft, which then sort of blankets the whole market. So it's possible that whilst we've got great trends in Australia and some great justifiable trends, that we could get a short, sharp sentiment downdraft that just sideswipes everything. Now, if you're looking out a few months, that will create some wonderful buying opportunities if it occurs. But if you're fully invested, riding the gravy train, then that might come as a bit of a shock to some. So just be wary of that. Precious metals, gold had a very robust week, up $70 to $27.70 in US. In Australian dollars, we're over 4,400 now. That's incredibly profitable territory, and finally see some more sustained response from our gold producers. Silver, $30.57. And if you look at the overall circumstances, it's a very conducive environment for precious metals prices to go higher. Now, I've lost count of how many times I've said that in the last 5 years, and precious metals prices have not done that. That is no guarantee of anything. All right, the gold stocks, the local trends certainly are looking better. So let's just take a quick look at those charts. So silver, first of all, not a lot of change. It's the weekly charts. Hasn't changed a great deal since May last year. All right, this is gold in US dollars for the week. So this is a new all-time closing high for the week. So it's new territory, and that is a very strong trend. So the breakout occurred in March of last year. So this has been running now for about 10 months, and it's moved up from around 2,060 to 2,770, about $700. In Australian dollars, the trend is equally impressive. Now this is Bitcoin, which I'll get to in a minute. So Bitcoin, we managed to surge to about 110,000, pull back to the low 90s, has then formed a bit of a W pattern and is managing to hold above that. So that's all pretty positive, pretty impressive stuff by Bitcoin. And as I've been observing over the last few months, the fundamentals around the demand just more and more assured as the months go by, because the bigger players are making the commitments, the infrastructure is being put in place, which I'll get to. Now, it's not to say that things aren't getting frothy in the crypto world, because we've got Trump and Melania meme coins, which have just been released and have already rocketed to a value of $16.5 billion. If that ain't crazy, I don't know what is. Not that I understand much about those meme coins. In a very positive move, though, the SEC has established a crypto task force for better regulation, and that can only be a good thing, because it will give the major players more confidence to continue what they've already started. And that is the major source of demand. It's more and more large financial players that are making the commitment to Bitcoin and other cryptocurrencies. Now, if we look at the chart, which we just had a look at, it closed just under 105,000 and peaked out at 107 for the week. So things looking pretty rosy for Bitcoin. Turning to other commodities, copper eased just a few cents to 4.29. Nickel was pretty steady. Crude oil also eased back from 78.5 back to 76.5. I had to smile. Trump has asked OPEC to drop their prices, reportedly quite politely. I can imagine what the OPEC response is going to be, and so that then begs the question, what comes next? I don't think Trump really likes being told no, so that's going to be a pretty interesting unfolding story as well. So wrapping it all up, this is the best way that I could find of expressing where things sit at the moment. You do not want to stand in front of a speeding train or a moving truck, because it'll just run you down. And the people that are saying and thinking that markets are overvalued because of this, that, or the other, or this can't continue, this is crazy because it's beyond our ability to process it. You don't want to do that. The trends and the money flows and the investment commitments and the sentiment that Trump has unleashed, justified or not, he has unleashed that sentiment, and that can drive trends to levels that are very, very hard to fathom. So you do not want to stand in front of speeding trains. Successful trading and investing is about probability. But at the moment, you can only conclude that the probability is in favour of companies growing their earnings and therefore prices moving higher. There are never certainties or absolutes in investing. It's just probabilities. And those probabilities are very clear in their direction. So do not stand there with your hands on your hips thinking, this is silly, I'm right, they're wrong, because you'll get run down. So don't do that. Portfolio analysts this week coming. We continue to build what I'd term higher probability watch lists. There is a process to stock selection that gets you much closer to success than just about anything else that I know. And it's pretty simple. It's pretty straightforward. Requires a fair bit of legwork, which is something I'm always extremely happy to do. And then all you need to apply to that is the cream on the cake is just bring some discipline and confidence to your investing, and amazing things can happen. There's more information on the website. There's my email address, and I'll be back with you next weekend. Cheers.